Good day, everyone. My name is Marjan Q. Velasco.
My name is Angela Bea Conanan.
My name is Marcella S. Manuncia.
My name is Florlyn Di Mateo.
And last, my name is Jeremy Garcia Gutierrez.
And we are the Group 5. And we are going to report about adelphia communication scandal. In this reporting, we will examine the history of creation and also the downfall of Adelphia Communications Corporation, as well as the lesson learned from its case. Okay, let's start. Um, the Adelphia Communication scandal is one of the most controversial financial scandal because it involved a massive fraud and cover up by the founder and executive of the company. Their scandal had a huge impact on the cable industry. The Adelphia Communication Corporation was a public company that provide cable television, internet, and phone services in the United States. It was founded in 1952 by brothers John and Gus Figas in Coudersport, Pennsylvania, where it had its headquarters. And this company grew to become one of the largest cable operator in the country, with over 2 million subscribers in by 1998. Nature of the bu- Nature of the business of Adelphia Communication Corporation. Their primary industry is cable service provider, and their other industries are internet service provider, broadcasting, radio, and television. And here where Adelphia Communication Corporation are located.
John Rigas and Timothy Rigas, who was Adelphia's former chief financial officer, were found guilty on 1 count of conspiracy, 15 counts of security fraud, and 2 counts of bank fraud. The Adelphia Communications Corporation fraud involves a complex scheme of financial wrongdoings perpetrated by the Rigas family, who owned and controlled the company. The scheme involves using Adelphias as their own personal piggy banks, taking a large loans, and using company's funds for personal expenses, including buyings, luxury cars, luxury homes, and personal expenses and personal assets. The family also created a series of off-banks balance sheet partnership that they used to hide debts and inflate the company's earnings. The Rigas family also engaged in other fraudulent activities, including falsifying financial statements. The family created fake transactions and accounting entries to overstate the company earnings and understate its liability. Trading. The family sold millions of dollars worth of Adelphia stocks while concealing the company's true financial condition from investors. Self-dealing. The family used their position at Adelphias to give themselves and their associates preferential treatment in business deals and investments. The fraud continued for several years, triggering a major scandal that led to Adelphia's bankruptcy and the criminal conviction of several members of the Regal family. The Adelphia's fraud was one of the largest and most complex financial fraud in U.S. history. and it's highlighted the need of better corporate governance and oversight to prevent similar abuse from occurring in the future. The Adelphia's Communications Corporation fraud lasted for several years, for at least the late 1990s, and it was uncovered in 2002. During this time, the Rigas family, who owned and controlled Adelphia, used the company as their personal piggy bank, taking out large loans and using company funds for personal expenses. They also inflated the company's earnings by hiding debt and creating fake transactions. The fraud continued until Adelphia's auditors discovered that the company had not disclosed 2.3 billion in off-balance sheet debt, which triggers an investigation by the Security of Exchange Commission and the uncovering of the fraud in 2002.
The financial losses incurred as a result of the Adelphia Communications Corporation fraud were substantial, and the company's bankruptcy was one of the largest in U.S. history at the time. The fraud resulted in Adelphia overstating its earnings by approximately $5 billion and hiding $2.3 billion in off-balance sheet debt. When the fraud was uncovered in 2002, Adelphia's stock price plummeted and the company was forced to file for bankruptcy. According to court documents, Adelphia's creditors lost approximately $7.2 billion as a result of the fraud. The company's bankruptcy also had a significant impact on its employees and customers, many of whom lost their jobs or experienced disruptions in their cable and internet services. The Rigas family was ordered to pay $1.5 billion in restitution to Adelphia shareholders, but it is unclear how much of this amount was actually recovered. The sale of Adelphia's assets to other cable companies helped to partially offset the losses incurred by the company's creditors. Several individuals involved in the Adelphia Communications Corporation fraud were convicted and sentenced for their actions. John Rigas, the founder and former CEO of Adelphia, was convicted of fraud, conspiracy, and securities fraud, and sentenced to 15 years in prison. His son, Timothy Rigas, the former CFO, was also convicted and sentenced to 20 years in prison. In addition to their prison sentences, they were ordered to pay $1.5 billion in restitution to Adelphia shareholders. Michael Rigas, another son of John Rigas and former Adelphia executive, was also convicted and sentenced to 10 years in prison. James Brown, former Vice President of Finance, and Michael Mulcahy, former Director of Internal Reporting, were convicted and sentenced to shorter prison terms. The Rigas family was also ordered to forfeit approximately $1 billion in assets, including their ownership stake in Adelphia, luxury homes, and other assets that they had purchased with company funds. The Adelphia scandal was one of the largest corporate frauds in U.S. history, and the severe punishment meted out to the perpetrators was seen as a warning to other corporate executives that such unethical and illegal behavior would not be tolerated.
To prevent fraud in a company like Adelphia, internal controls are essential. Internal controls are policies and procedures that are designed to safeguard a company's assets, ensure the accuracy and reliability of financial reporting, and promote compliance with laws and regulation. Here are some internal controls that could help prevent fraud in Adelphia. First, segregation of duty. One of the most effective internal control is to separate the duty of employees involved in financial transaction. Segregation of duties intended to minimize the occurrence of errors or fraud by ensuring that no employees has the ability to both perpetrate and conceal error or fraud in the normal course of their duties. Example, the person who authorizes payments should be different from the person who records those payments. This would prevent any one individual from having too much control over the financial transaction and reduce the risk of fraud. Second, oversight by an independent audit committee. An independent audit committee can provide oversight of the company financial reporting and internal controls. The committee should consist of independent directors who are not involved in day-to-day operation and have the expertise to understand financial statement and audit reports. Audit committee are responsible for overseeing the performance and quality of the audit as well as the independence of auditors. Third, clear policies and procedure. Adelphia could have implemented clear policies and procedure for financial reporting, include the preparation and review of financial statements and the disclosure of related parties transactions. Such policies and procedures should be documented and communicated to employees to ensure that there are responsibility and the expectation of the company.
Number 4, regular internal audits. Regular internal audits reveal gaps or identify weaknesses in the company's internal controls and prevent fraudulent activities. The internal audit function should be independent and report directly to the audit committee. Whistleblower program. Adelphia could have implemented a whistleblower program that would allow employees to report any suspected fraudulent activities anonymously. The company should also have a policy that prohibits retaliation against employees who report suspected fraud. Adelphia might have developed a whistleblower program that would allow employees to report any suspected fraudulent acts anonymously. The organization should also have a policy that prevents retaliation against employees who report suspected fraud. External audits. External audits are performed by independent auditors who are not employees of the company. These audits can provide an additional layer of oversight and assurance that the financial statements are accurate and complete. These audits can give an additional degree of monitoring and confidence that the financial statements are accurate and full. An external audit process guaranteed that business internal controls, processes, guidelines, and policies are adequate, effective, and in compliance with legislative laws, industry standards, and corporate policies. This kind of audit makes sure that reporting processes guard against financial statement inaccuracies. Overall, implementing these internal controls would have helped prevent fraud in Adelphia. It is important to note that no internal controls can completely eliminate the risk of fraud, but they can help reduce the likelihood of incurring and mitigate its impact. Overall, Adding these internal controls would have helped prevent fraud in adelphia. It's crucial to recognize that no internal controls can totally eliminate the risk of fraud, but they can assist lower the likelihood of it occurring and limits its damage.